Code 3 Americans, in this video, we're going to go over how and why you may want to own treasury bills as an alternative to cash. First, nothing is tax or financial advice in this video. It's just ideas and information. But I've talked about many times that nobody really cares about how much money they have. What they really care about is how much purchasing power they have. In other words, what the money will do for them. So this year, you can buy a certain amount of house, certain number of groceries, certain amount of insurance, and so forth. And next year, you're wondering, how much can I buy of the same thing? A lot of times we tell ourselves things got more expensive when really what happened was the currency, the dollar in our case, simply became worth less over that year or period of time. Therefore, it takes more of them to buy whatever good or service we're trying to buy. So, what we really need to focus on first is preserving our purchasing power. And then, of course, everybody wants to grow wealth. So then we start to find investments or certain opportunities that'll allow us to earn a yield above whatever the inflation rate is. Now we got inflation rates can are made up of the CPI and so forth, but they're different for everything. You know, it's not just 3 or 4%. Depends really what you're doing. You may be planning to have an expenditure next year that could be much higher or much lower than the consumer price in inflation rate. So that's something to keep in mind as you're managing your cash positions. So then we got to talk about what are treasury bills and what is cash? Well, cash is simply a unit of measure. That's what currencies are. We've done videos on that, where a dollar is simply like feet, inches, ounces, pounds, barrels, acres, or square feet. It's simply a unit of measure that we use to trade with one another to make commerce efficient. But it's not the dollar that's of value, it's what the dollar does for us. It's not what the square foot is, it's the space that it provides for us. It's not the barrel, it's the oil, and so forth. So
So
T bills are a risk free alternative to cash. So when you talk to very wealthy people that have millions or even firms that have billions of dollars, they're not putting that volume of money in the bank in the form of cash. First of all, that would be nuts because the FDIC insurance only covers about $250,000 for bank deposits. So in other words, if the bank goes bust, like we saw in early 2023 with Silicon Valley and some other banks, only you would only be insured up to $250,000 at that institution. Anything above that, you could be subject to loss. So, what big firms do or wealthy people do when they come into large volumes of cash is they will move that into short term treasuries, which are called T bills. So, T bills come in various terms. It can be 4 week, 8 week, 3 month, 6 month, and so forth, up to a year. But it's considered a risk free alternative to cash because they're backed by the US government, which in the United States is the only entity that can't go bust because they can create more money. So again, risk-free alternative to cash so that the cash doesn't have to be sitting in a bank above FDIC limits, yet it's also very liquid because it will mature in 4 weeks, 8 weeks or whatever the term is. So there's been a lot of talk about T-bills of late and it's because of the following reasons. So here's a chart at the Wall Street Journal talking about T-bill rates over the last 3 years. This is a 1 month T-bill, as you'll see. You can see it. They just brought nothing for many, many years. And if we could get a chart that go back further than 3 years, you'd see this is flat for a long time and was just dead. That's because of very, very low interest rate policies, or ZIRP as they call it, zero interest rate policy. Well, now to combat record high inflation, the Federal Reserve has been raising interest rates at a record pace on the short end of the curve. In other words, when you hear the short end of the curve, they're talking short term treasury bills, and the long end of the curve would be 20 or 30-year bonds. So here you'll see on the short end of the curve, we used to bring about a third of a percent. And now in July 2020, or I'm sorry, late 2023, we're bringing about 5.4% in yield on the same T-bills. And again, these are backed by the government. And if you scrolled through and you looked at different terms, you would see it's the very same scenario. So how does that compare to, say, the savings rate? If you go to a bank, in 2022 is bringing 6 basis points or 6/100ths of a percent, and now in October 2023, it's bringing about 0.46%. People ask me about CDs. which is a certificate of deposit. It's essentially your promise to the bank that you'll leave a deposit in their bank for a specified period of time. Well, the bank likes that because checking and savings deposits are more liquid. There's more velocity behind it. In other words, a depositor could come in, withdraw that money, could withdraw that, make that claim on those deposits, and now the bank loses those deposits. Well, if they're trying to loan the money out at a higher interest rate than they're paying you, that's called arbitrage, then that's a risk to them. So they're willing to pay more if you'll guarantee them that you're going to leave that deposit in the bank for a longer period of time. And that's what a certificate of deposit essentially is. So I've had people talk about CD rates, making even 4%. This is just a national average. You'll see it's about 1.79 at the high end there. But I've heard people talking about, say, 4% at some local banks. Well, first of all, we have to talk about counterparty risk. So what is that? If I make a deposit at the bank is a counterparty to me, and there's risk in every layer of counterparty. In other words, the bank has to perform on their business plan and they have to remain solvent, or I could lose my deposit. This is much like the borrowers that borrow the money from the bank. They also, if somebody comes in to get a loan, they also have to perform on that loan in order for the bank to make their profits and therefore pay me the interest rate they promised to pay me for the deposit I made. So if the borrower defaults on their promise, that would affect the bank and then that would affect me. So therefore, the bank and the borrower are both counterparties to this transaction when I made the deposit, in other words, to the promise. So both of those carry risk. And obviously, the more people involved, the more the risk can compound. So I've asked people, why in the world would you go to a bank and place a certificate of deposit in today's day and age of, say, 3-4% when you have multiple layers of counterparty risk? In other words, I'm going to take 4% yield in an environment that produces more risk for me than I could get in, say, a T-bill. I could get a higher yield and far less risk. Again, T-bills are considered to be the risk-free alternative to cash. It is the most pristine collateral in the world is US Treasury bills. So again, why would we take more risk to get less yield? So a lot of people will own treasury bills because you can manage your cash positions. You can buy 1 month, 3 months, 6 month, um, up to a year T-bills to manage your position. So if you thought you had an expense coming in, say, 6 months, you could own some 6 month T-bills and have those mature right before your expense. If you wanted to keep a little bit of cash in the bank to handle short-term emergencies, you could leave that in cash. And then if you wanted to keep um, a larger quantity of cash, say maybe you had $500,000 and you wanted $50,000 in operating capital, you could leave that in cash, say, for an example. You could then take maybe another $100,000 and leave it in a 4-week T-bill, knowing if you had a bigger problem or an expenditure come up by the time the work was done and you got the bill, then your 4-week bill would mature, because again, it's going to mature every 30 days. So now you're back to cash again to handle your expenditure. And then your excess money, maybe you could take the other, whatever, $350,000 and put that in a 6 month T bill or 3 month or 1 year or whatever fit your upcoming needs based on your budget projections and your expenditure projections going in, into the future. So that's why you would want to own T-bills, and especially in today's market. They're at the highest rates they've been in many, in decades now, and they have less risk than banking products. And something real quick before I show you how to buy the T-bills, something to consider if you start looking at banks, whether it's savings deposits or it's CDs, if they're paying more than other banks, well, you got to remember that's an expense to the bank. So why would a business want to pay more expense and reduce their margin? It's probably because they're having either a hard time getting deposits, or maybe their expenses are too high, or they're having some hardship and they need those deposits. So in other words, that could be an early warning indicator of a problem. So just something to keep in mind there. So how do we own treasury bills? Very, very simple in today's day and age. Used to be you had to go through a bank or a financial planner or something like this. They don't even want to talk to you about them anymore. You can just go to treasurydirect.com. Now, you cannot trade on the market here. This is not to invest in treasury bills. in terms of buying low and selling high and trying to make capital gains and play the market, you're going to have to go outside of this site through a bank or financial dealer or something like this to play that game, to play them as a capital gain where you're trying to buy low and sell high or time the market. But here, if you're just looking for a place to place cash for yield, you just go to treasurydirect.gov and set up an account. And it'll be pretty self-explanatory about how you open a new account right here. And then what you can do is you can go to auctions and you can see announcements and data results. So what that does is that'll bring you over here to your announcements and data results, and you can kind of get an idea of what previous or various terms of T-bills have been bringing. So these are very recent auctions, and then it'll tell you whatever the investment rates are, whatever they're bringing for a 4-week, 8-week, and so forth. So you can kind of plan out what you're willing to do, and you can pick different products here if you see fit. Then you can go to the auction results page and you can check auction dates and settlement dates. Now, what that means is, so on this date, for this as an example, there was an auction on October 12th for a 4-week T-bill, and then it settled on October 17th. So this was the auction, and this is when you would pay for it and the trade would be finalized. And then you can scroll down through here and see what auctions are upcoming, and you can just pick to participate in those. Now, on this website, on treasurydirect.gov, when you're participating in an auction, you're actually not bidding. What you're doing as a retail investor is you're saying, hey, in layman's terms, you're saying, hey, I'm willing to take whatever the market rate is. In other words, the big players, the institutional money will go in and bid on those products, and that will set the rate. So you're simply saying, I'm willing to accept that auction rate. You're not actually bidding. But you can look at the historical rates, and you can go to places like the Wall Street Journal and get a pretty good idea of what's happening in the bond markets. I watch this, or we watch this probably 6-8 times a day. It's really a barometer of what's going to happen in every other sector of the financial markets, like we've talked before. So that's the reason you'd want to own treasury bills, to use them as a risk-free alternative to cash. They are the safest thing. They're considered no risk because essentially the government would have to default before they could default. So you would actually argue that the banks are higher risk than the treasury bills. That's why they're the most pristine collateral in the world. So if you want to see more resources, you can just go to our website, code3assets.com. All sorts of free resources on here, different downloads, products. All of it's free. YouTube videos. You can go on here and download a free copy of a #1 best-selling book that I was a part of. It hit #1 in I think over 30 categories on Amazon, several of them international. So it's pretty proud to be invited into that. It's a great book. You go on there, download that free digital copy of that if you'd like it. And then you would also get in our Code 3 American community, where you get invited to online meetups where we talk about information like this. And you also receive our newsletters and so forth.